Mark your calendar right now because Trump is about to flood this market with more money than most of you have ever seen move at one time. And it's happening on a specific date that almost nobody is talking about. I'm not guessing here. I'm not doing some dramatic YouTube countdown for clicks. This is real. It's coming fast. And if you don't understand what's about to happen to the dollars sitting in your bank account, you are going to get run over. I've built companies, I've sold companies, I've watched markets rip and crash more times than I can count. And I'm telling you straight, this is one of those moments where the people who pay attention walk away ahead, and the people who don't find out the hard way, usually about 6 months too late, when it's already showing up in their grocery bill and their rent. So sit still for the next half hour. I'm going to break this down the way I'd explain it to my own kids. No jargon, no Wall Street nonsense. Just what's happening, why it's happening, and what you do about it. Before I get into it, I need you to do one thing for me. Hit subscribe right now. I mean it. What I'm about to walk you through in this video is the kind of stuff people pay real money for, thousands of dollars, to sit in a room and hear from guys like me. You're getting it for free because I actually want regular people to stop getting steamrolled by stuff like this. So subscribe, turn on notifications, because I'm not doing this once. I'm going to keep tracking this in real time as it plays out, and you don't want to miss the follow-up when this thing actually hits. Let me set the stage for a second before I dig into the mechanics, because I think context matters here more than most people realize. I've been in and around money my entire adult life, from selling a company for over $5 billion, to sitting courtside owning a professional basketball team, to sitting on Shark Tank listening to entrepreneurs pitch me their life savings on national television. I've seen booms. I've seen busts. I've seen dot-com mania, and I've seen 2008 nearly take the entire financial system down with it. So I'm telling you this not to brag. I'm telling you this so you understand that when I say this next stretch matters. I'm not saying it because it gets clicks. I'm saying it because I've watched this exact movie before, and I know how it ends if you're not paying attention. So let's get into the actual mechanics of what's happening, because this is where most people's eyes glaze over, and that's exactly why they get caught flat-footed. The government has debt, a lot of it, and when that debt comes due, they've got to either pay it off with cash they already have, which they don't, or they've got to roll it over, meaning they issue new debt to cover the old debt. Normally, that's not a big deal. It happens all the time. It's boring. Nobody notices. But here's the piece that changes everything this time around. Instead of just quietly rolling debt like usual, there's a coordinated push starting on a specific date where the government, working through the Fed and the Treasury, starts buying up a massive chunk of that debt using newly created money. Not money that already existed, not money that came out of taxes. Brand new money created out of thin air and pushed straight into the system. That's the flood. That's what I'm talking about when I say flood the market. It's not a metaphor. It's literally what's about to happen. Now, here's why this matters to you and not just to some hedge fund guy in New York. When new money gets created and pumped into the system, it doesn't just disappear into some vault. It moves. It goes into bonds. It goes into stocks. It goes into the banking system, and eventually it works its way down into everyday prices. Every dollar that gets printed makes every other dollar that already exists worth a tiny bit less. You don't feel it the day it happens. You feel it 3, 6, 9 months later when your same paycheck buys less at the grocery store, when your rent renewal comes in higher, when the mortgage you were hoping to get suddenly costs more because rates react to all of this too. This is not some abstract economic theory I'm throwing at you. This is math. And when you increase the supply of something, in this case dollars, and the demand for goods and services doesn't grow at the same pace, the price of those goods and services goes up. That's inflation. And it is coming, whether people are ready for it or not. Think about it like this. Say you run a lemonade stand and there are $100 bills floating around your neighborhood that people use to buy lemonade from you. Now imagine somebody sneaks in overnight and hands out another $100 bills to everybody on the block, but you're still only making the same amount of lemonade. What happens? People still want lemonade. They've got more cash in their pocket now, so they're willing to pay more per cup because there's more money chasing the same amount of product. That's it. That's the whole concept. Scale that lemonade to the size of the entire United States economy with trillions of dollars instead of $100 bills, and you got exactly what's about to happen. It's not complicated once you strip away the jargon they use to make it sound complicated. And they do that on purpose, by the way. The more confusing they make it sound, the fewer people push back or ask hard questions. I want to be really clear about something because I know how this stuff gets twisted online. This isn't a Trump good or Trump bad conversation. I don't care what you think of the guy politically. I've built and run real companies my entire adult life, and I can tell you that money printing doesn't check your politics before it hits your wallet. It hits everybody. Democrat, Republican, doesn't matter. Doesn't care who you voted for. What matters is whether you understand what's coming and position yourself accordingly, or whether you get caught by surprise like most people are about to. Now let's talk about history, because this is not the first time a government has done this, and it is definitely not going to be the last. Every single time in modern history that a country has significantly ramped up the printing of its own currency to cover its debts, the same pattern has played out. I've watched it happen more than once in my own career. It starts slow. Officials go on television and use soft language. They call it stimulus. They call it liquidity support. They call it quantitative easing. Anything that doesn't sound like what it actually is, which is printing money. And for a little while, it actually feels good. Markets go up, stocks rally, people feel richer on paper. That's the part everybody loves and nobody wants to question. Because who doesn't like watching their 401 kilobits go up? But that first wave is always followed by a second wave that people don't see coming because they're too busy enjoying the party. The prices of everyday things start creeping up, not all at once, but steadily. Food, fuel, rent, insurance. And here's the part that really gets people. The prices almost never come back down. Even after the money printing slows or stops, businesses that raise prices to cover higher costs don't lower them again once costs level off. Because why would they? So you're left in a permanent new normal, where your dollar buys less than it used to, and your paycheck has to stretch further just to keep up with where it was before. I lived through versions of this in my own businesses. When costs go up across an entire economy, every business owner has a decision to make. You either eat the cost and shrink your margins, or you pass it on to the customer. Most businesses, especially small ones without huge cash reserves, have to pass it on. That's not greed, that's survival. And when millions of businesses make that same decision around the same time, you get exactly what we're talking about. A broad, sustained increase in the cost of living that outpaces how fast people's wages actually grow. Wages are always the last thing to catch up, always. That lag is where regular families get squeezed the hardest because your rent goes up in month 1, but your raise doesn't show up until month 12, if it shows up at all. I remember sitting in meetings back during the last big inflation run, watching business owners I know personally, guys running restaurants, guys running small manufacturing shops, agonizing over whether to raise prices on their customers. Nobody wants to be the guy who raises prices. You lose customers, you get angry phone calls, you get one-star reviews from people who don't understand what's happening upstream. But the alternative is going out of business, and going out of business helps nobody. So prices went up everywhere all at once, across every industry you can think of, because everybody was dealing with the exact same squeeze at the exact same time. That's what a systemic economy-wide event looks like. It's not one bad actor raising prices to gouge you. It's millions of separate decisions all being forced by the same underlying cause. And here's the thing, nobody tells you about the recovery phase. Even once the printing slows down, even once things stabilize, prices very rarely go back down to where they started. Deflation, meaning prices actually falling back, is incredibly rare and usually only happens during a real economic disaster, which is its own separate problem. You don't want either. So what you're left with after a period like the one we're about to enter is a permanently higher cost of living, The new normal becomes the new normal. And that's exactly what happened the last time this played out. And there's no reason to believe this time is fundamentally different in that regard. So let's bring this back to your actual life, because I don't want this to feel like some economics lecture. Here's what this looks like in practice. In your day-to-day life, your savings account, if you're one of the smart ones who actually has money saved, is quietly losing purchasing power every single day this continues, especially if that money is just sitting in a checking account earning basically nothing. $100,000 sitting in cash for the next 2 or 3 years while this plays out could easily lose 10, 15, maybe 20% of its real buying power, even though the number on the screen never changes. That's the sneaky part. Your bank statement still says the same number. It feels safe, but what that number can actually buy you keeps shrinking. If you're someone carrying debt, this cuts the opposite way, and it's worth understanding both sides. Fixed rate debt, like a mortgage you locked in a few years back at a low rate, actually becomes easier to pay off in real terms when money printing accelerates, because you're paying back that debt with dollars that are worth less than the dollars you originally borrowed. That's one of the few silver linings in all of this, and it's exactly why you'll hear savvy investors, myself included, talk about the difference between good debt and bad debt during periods like this. Fixed low-rate debt on an appreciating asset, that's a very different animal than high-interest credit card debt, which will absolutely wreck you no matter what the Fed is doing. Let's talk about the grocery store for a second, because that's where most people are actually going to feel this first, way before they see it in any headline about the Fed or the Treasury. Think about what goes into a jar of pasta sauce, making it to a shelf, farmers growing the tomatoes, fuel to transport them, workers to process them, packaging materials, trucks to ship it, and a retailer marking it up to cover their own rent and payroll. Every single link in that chain gets touched by rising costs when the dollar weakens, and every link passes a little bit of that cost down to the next one until it lands on you at the checkout counter. That's why grocery prices tend to be one of the fastest and most visible signals of what's happening underneath the surface. If you want an early warning system for how this is playing out in real time, watch your grocery receipt, not the cable news chyron. Now let's talk about what the people with real access and real information are doing right now, because this is the part that should get your attention. When Trump files hundreds of trades right around the same window that this printing is set to begin, that's not a coincidence you should just shrug off. I'm not saying anybody's doing anything illegal. I want to be clear about that. But think about it from a pure business logic standpoint. If you knew with a high degree of certainty that a wave of new money was about to hit the system, where would you want your money positioned before that wave hits? You'd want to be in assets that historically hold up well or even benefit when the dollar weakens. Hard assets, real estate, certain stocks, especially in sectors tied to infrastructure, energy, and companies with strong pricing power, meaning they can raise their prices without losing customers. You would not want to be sitting in a pile of cash earning 2 or 3% while the value of that cash gets quietly eroded underneath you. This is exactly the kind of positioning I look for in my own investments. And it's exactly what smart money does before periods of currency expansion. They don't wait for the headline. They don't wait for their neighbor to tell them prices went up. They position ahead of time, because by the time it's obvious to everybody, the easy money has already been made by somebody else. I want to give you a real example from my own life, so this doesn't feel like some vague theory. When I sold broadcast.com back at the peak of the dot-com boom, one of the smartest things I did wasn't picking the next hot stock. It was hedging my position and diversifying out of a single concentrated bet before everybody else figured out the party was ending. The people who got hurt in that crash weren't dumb. They just didn't move early enough, because moving early always feels a little bit premature and a little bit uncomfortable. Nobody claps for you when you make a defensive move before the crowd sees the danger. You usually look overly cautious, maybe even a little paranoid, right up until the moment you look like a genius. That's exactly the position you're in right now with this printing wave. Moving now before September. Before it's obvious to your neighbor, your coworker, the guy at the gym, that's when it actually matters. Waiting until it's on the front page of every website means you're moving with the crowd, and the crowd is usually the last one to benefit. So let's get practical, because I don't want you walking away from this video informed but stuck, not knowing what to actually do with your hands. First thing, and this is non-negotiable, get a real handle on your cash position. If you've got a big chunk of savings just sitting in a low-interest checking or savings account doing nothing, that money is a melting ice cube right now. I'm not telling you to do anything reckless or panic-driven. I'm telling you to, at minimum, get that cash into something that at least keeps pace with inflation, whether that's a higher yield account, treasury bills, or other short-term instruments that actually pay you something close to real inflation rates. Second, take an honest look at your debt. If you've got high-interest debt, credit cards, personal loans with rates north of 15–20%, that debt does not become your friend during inflation. It stays your enemy regardless of what the dollar is doing, because those interest rates typically move with or ahead of inflation. And get aggressive about paying that down before you do anything else on this list. On the flip side, if you've got a low fixed rate mortgage, there is genuinely less urgency to rush and pay that off early during a period like this, because you're repaying it with dollars that are worth less over time. Third, think hard about where your long-term money is parked. I'm not going to sit here and tell you to buy this stock or that stock. I'm not your financial advisor, and anybody who tells you exactly what to buy in a YouTube video is somebody you should be a little suspicious of. But historically, businesses that own real assets, that have pricing power, that can pass rising costs on to customers without losing them, tend to hold up far better during these stretches than companies with thin margins and no real advantage. Real estate, especially income-producing real estate, has also historically been one of the better hedges against this kind of currency expansion, because rents tend to rise along with everything else. Fourth, and this one gets overlooked constantly, protect your income, not just your investments. The best hedge against inflation isn't some clever trade, it's increasing your own earning power. Negotiate your salary, build a side business, invest in a skill that makes you more valuable. Money you print with your own two hands through skill and hustle doesn't get diluted the way sitting cash does. I built my entire career understanding that your own earning ability is the one asset nobody can inflate away from you. Fifth, don't overcorrect and do something stupid out of fear. This is the mistake I see over and over again whenever I talk about stuff like this. Somebody watches a video like this one, gets spooked, and goes and dumps their entire life savings into some speculative coin or some random stock a guy on the internet told him was going to the moon. That is exactly the wrong move. Fear makes people abandon good judgment, and good judgment is the only thing that actually protects you long term. Everything I just walked you through, cash management, debt management, asset positioning, income growth, none of it requires you to gamble. It requires you to be deliberate, patient, and a little bit boring, honestly. Boring and consistent beats panicked and reckless every single time I watch this play out in my businesses and in my own personal investing. One more thing I want to hit on, because people always ask me this. Timing the exact top or bottom of anything is basically impossible, even for people who do this professionally for a living. I'm not telling you to try to perfectly time September 9th like it's some magic switch that flips. What I'm telling you is the direction of travel is clear, and clear direction is worth a lot more than precise timing. You don't need to know the exact day your house catches fire to know it's smart to have insurance. You just need to know the risk exists and act accordingly ahead of time, not after the smoke's already in the room. Here's my challenge to you, and I mean this. Don't just watch this video and nod along and go back to scrolling. Pick one thing from what I just laid out, just one, and actually do it this week. Move some of that idle cash somewhere. It's working for you. Make a real plan to knock out that high-interest debt. Have one honest conversation about your income and whether you're being paid what you're actually worth. I've watched too many smart, capable people sit on information exactly like this and do absolutely nothing with it, and then wonder 6 months later why everything feels tighter. Don't be that person. Subscribe if you haven't already, because I'm going to keep tracking exactly how this plays out in real time. And I want you here for it. Drop a comment, tell me which one of these moves you're making first. I actually read them. Money's about to move fast in this country. Make sure you're moving with it, not getting left behind by it,